Escrow account. So as an organization, I do not have any control of money. The control of money is with the trustee. We just pass on the instructions to trustee, and trustee is the one who instructs the bank to move the money. So what it means is that technically all the data that we have of the lender and the borrower goes to the trustee. And that's how the trustee instructs the bank to move the money. So it also means that if tomorrow, if you don't exist, all this data is with the trustee. And the money is with the trustee and with this particular account. So in this particular escrow account, every lender gets an individual escrow account. Okay, so it's a umbrella escrow account of Faircent under which all the lenders open their account. And that money is protected with the trustee, and the trustee is the one who decides. We just have the viewing rights for this account. We don't have any other rights. So borrowers who are on the platform, they are insured. This is, if he opts out, then the insurance doesn't work. But otherwise, opt-in, all the guys are insured on the platform on the loan amount they've taken. I talked about this. All the collection happens through NAC, which is 100% NAC. Okay. Now, system level, there are a lot of risk and mitigations that we take care of. Now, this is very interesting. Why is the bank's business model more powerful than a NBFC business model? There are 3 guiding principles for it. The first principle is fractionalization. So banks don't, give all the money to one particular, borrower. They kind of fractionalize that to a large number of people and distribute to a large number of people. So that's what you're expected to do. Your money does not, so for example, if I need ₹1,00,000, you don't give me ₹1,00,000. You just give me 500 bucks. Okay, rest, I pick up from 200 other lenders. So that's the way the model works. It is not that it's one-to-one. So it's fractionalized in a certain way that 90% of your risk gets mitigated there because you pick up large number of borrowers with the amount of money that you're getting in with. So that's rule number 1 which the banks follow. Rule number 2 is distribution. Banks don't lend to one particular city, okay? They'll lend it out to large number of cities. So you're operating in one city or one state, it doesn't work because state or city can have concentration risk, geographical risk. So it's always better to kind of, distribute yourself to large number of cities. So the platform gives you an option to kind of distribute to at least 300 cities. There have been cases where people were emotional about investing in their particular city. For example, there was somebody who investing only in Tamil Nadu. There were people investing only in Kerala. And we saw in these two places floods happened and a lot of businesses lost a lot of money. So it doesn't make sense to kind of invest in one city, kind of put out a large number of cities. So that's why banks have a lot of branches across the country. And the third rule is different kinds of loan products. So banks have different kinds of loan products. So do we have. So we have business loans, salaried, student loan, line of credit. We have micro loans, daily loans, weekend loans. But these are all unsecured loans. But within that, there are, we have broken this up. Some have high risk, some have very low risk, some have absolutely no risk. So we have different kinds of loan now. So these are 3, golden rules in which banks operate. So what we've done is we use technology to make it and made an individual lender a bank. So that's how you transact on the platform. So which means that you invest small amount of money in large number of borrowers to make a decent return. You can also, rather than individually picking up the borrower, if you are hard pressed for time, the platform gives you an option to auto invest. So you kind of park your money and you set some parameters. Your money kind of gets invested in borrowers of the parameters that you have picked up. And how it picks up is basis its intelligence. So there is an intelligence of hundreds and hundreds of lenders who are built in. It takes that intelligence to kind of distribute your money. So what it does is that it picks up top 1,000 lenders and see how much have they made and how is it that they've made, okay, the money, whichever risk category that you're riding on, and it kind of picks up those set of borrowers and distributes the money. So if there is somebody who's made more money than the existing list, it gets replaced by this new guy who comes in. So it's a learning process. It's a machine learning process by which this keeps getting better and better. And same is the case with the underwriting or the credit analysis. The credit analysis also is based on machine learning, which basically tries to figure out why is it that this guy defaulted, and what is the reason for that. If there is any signal, we kind of plug that signal into the rule engine and give a weightage to it, so that next time when he comes onto the platform, a similar kind of a borrower comes onto the platform, either the rate of interest goes up or goes down depending upon the signals that you've got. So lenders get a very detailed dashboard, and there's a lot of data analytics on that dashboard for you to consume. So now this data analytics helps you to make your investment and course correction. For example, if the platform data says that Bangalore has more default than Hyderabad, Hyderabad has less default, and you invested more in Bangalore and less in Hyderabad, it's time for you to invest in Hyderabad. So that's what it does. So what it does is that it picks up your investment and looks at your investment, rationalize the platform investment to your investment level, and gives you a snapshot comparison for you to kind of course correct. And this data is on various cuts. I think there are some 30 odd cuts. It's by city, it's by age, it's by state, it's by CIBIL score, it's by male, female, married, unmarried. The reasons for picking up a loan, various reasons, there are some 30 odd reasons through which you can do the course correction. So this is currently not charged. Beyond 90 days, there is a small fee that I pick up before I kind of hand it over to the lender, the money. So that's a revenue option for me. So yeah, so that's the kind of return that one could expect, risk-adjusted return. Yeah, that's all. Thanks.